Welcome, Facebook. This is Adam Ashba, Realtor and President of Ashmont Realty, and welcome to Ashmont Live exclusively on Facebook. Well, beautiful May weather we're having in the Midwest. Excited to see that. So 70-degree weather all week, no rain. So let's dive into weather's good. And let's talk a little bit about mortgages. One thing we always think about is when we get older is we always think about when we get our house paid off. A lot of people try to pay off their mortgage before they hit, before the kids go off to college, and we've talked a lot about mortgages. But I read a really good article in Realtor.com, and it got me thinking a little bit about, especially in today's environment where mortgage rates are so low. So let's go ahead and dive into this article. So 5 reasons why you should not pay off your mortgage early. So let's start at the top. Okay. All right. First and foremost is you get a tax break on the interest that you pay. Now, you get a tax break on also the property taxes, and they've talked about that for a long time about removing that tax exemption. However, but still as it stands, every penny of interest that you pay on your mortgage loan, it's tax deductible. So depend on how much, your first few years, about 99% of everything that you pay of interest, every month that you pay on your mortgage payment, 99% of that goes to interest. You literally make little to zero dent in your principal, in the first few years of your mortgage. And we did a vlog not too long ago about how to accelerate paying off your mortgage a little quicker by making an extra payment every year. Everything from doing a 30 to a 15. If you haven't seen that, check out. It's on Facebook and YouTube. So, all right, let's move on to number 2. You can take out a home equity loan. All right, well, a lot of people don't even know what a home equity loan is. I don't know. I kind of disagree with this. You can take out a home equity loan on a property that that does not have a mortgage on it. So a home equity loan basically means that you can take a line of credit. Think of it like a huge credit card, a revolving credit card that you can borrow against your house. The interest rates are really low. But literally you can have checks and a credit card with it. Everything you borrow on that credit card, so to speak, it's tax deductible. Really, really popular 15, 20 years ago when I was on the mortgage side. But, with the whole predatory lending, it got out of hand. But, we're back in that cycle again. People are seeing appreciations of home values. We're really getting ourselves right back into the same issue we had back in the early 2000s. But yeah, you can take a home equity line or loan off your house. Let's go to the next one. This one makes a little sense. This was really popular when I was in the mortgage business during the dot-com boom, where you can be making higher returns on other investments. So instead of paying your house off or, a huge chunk of your house, take that money, invest it elsewhere. Now, you're not going to get it at the bank. I mean, we all know that interest rates at banks right now are literally, minimal to nothing. Literally, it's almost zero. But there's a lot of people that are investing in things such as cryptocurrency. Stocks are super inflated right now. But it gives you an opportunity in which you can take that money instead of paying off, paying on your mortgage, you can use that money to invest in something else. Okay. All right. Let's talk about the most obvious ones. And this is basically if you have higher debt on other interest rates. So say you have credit card. So you have a credit card, an average of 8, 10, 12, 15% interest rate on a credit card. I think a lot of this is somewhat common sense. You want to pay off your highest debt loans or lines of credits off first, because that's what hurts you the most in interest. So if you do have a credit card that's outstanding, pay that off first, or a car loan. Car loans are pretty low, but they're going to be a little higher than a mortgage. But pay those off first before you start tackling, your mortgage. And last but not least, I think this is really important. But last but not least is make sure you have an emergency fund and retirement. This is a great question that arose with a lot of financial advisors. Check with your financial advisor. I'm not licensed in that, but you can borrow money against your house pretty easy, but you can't borrow money when you retire. So you want to make sure you have some retirement first. And that also goes for school loans for kids. You want to make sure you have some sort of nest egg or just emergency fund, worst case scenario. Just something that you have some money set aside in case of emergencies. It happens all the time. So I hope that helps. 5 reasons why you should not pay off your mortgage early. I think we all want to pay off our mortgages early, but there's 5 reasons why you shouldn't. If you disagree with these, I think I disagree with one about the home equity line, but put a comment below. I love to hear your counter arguments. Love to hear. Make sure you like and subscribe. You can find us on Facebook at ashmontrealty.com, or you can find me on Facebook at Adam Ashba Realtor, also on Facebook. But comment below. We love to see your comments. Other than that, I'm out. Have a great week. Thursday afternoon. Enjoy the sun, and we will see you next week. See you later, guys.